Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. In this special episode, we focus on two very innovative real estate and housing ETFs. In the first part, my guest is Alexei Panayotopoulos, co-founder of Fundamental Income. And in the second part, I speak with Alex Petty, president of Hoya Capital Real Estate. Joining me now is Alexei from Fundamental Income, and we are talking about the Net Lease Corporate Real Estate ETF. Alexei, welcome and thanks for joining us.
Thanks for having me.
So you created the Fundamental Income Net Lease Real Estate Index, which is tracked by the Net Lease Corporate Real Estate ETF with the ticker symbol NETL. It is the first Net Lease REIT ETF, and this ETF made its debut in March this year. And in fact, it has significantly outperformed the broader REIT ETF VNQ since then. So just to start, tell us a little bit about your background and what exactly is Net Lease Real Estate?
We started the fund March 22nd of 2019, and really this is the brainchild of my partner, Chris Burbach, who was the former head of credit in capital markets at Store Capital, which is one of our largest constituents in the top 5 holdings. And this really came about when he was looking around in capital markets functions and seeing other companies that did similar functions to Store Capital, and we realized that there was a void in the market for a product and an index that tracked the net lease space. And the net lease space is unique mainly because it's centered around a business model as opposed to a property type. Mm-hmm. So when we say net lease, we're referring to the operative document that controls the properties and the lease between the landlord and the tenant. And it's not just any type of net lease. It's mainly single-tenant freestanding properties where the property is specific to one tenant alone. So we exclude all mall REITs. There are no malls, no office REITs, no multifamily, and really very little or none when it comes to multi-tenant exposure from a property perspective. And this is important just because the entire business model is centered around this function. And a net lease is essentially when the tenant is paying all the rent, property taxes, property insurance, as well as maintenance expenses, CapEx, and maintaining the property itself. And that's important because it allows the REIT itself to have a high level of operating leverage and efficiencies. So it realizes economies of scale in the sense that they don't need to manage the properties. If you go to a mall, you have to think about multiple levels of management, the landscape, the snow plowing, the lights, the security, et cetera, et cetera. In a single tenant property like a Walgreens or like an Amazon distribution facility or, a Chili's restaurant, the tenant is bearing all that expense. Does that make sense?
Yes. So you mentioned that there are no malls, no multifamily in these net lease REITs. So what kind of properties are net leased?
Net lease is a wide variety of property, and frankly, it's agnostic to property type.
Okay.
So you can do a net lease to any type of business that operates a facility. So it could be, grocery stores, it could be pharmacies, it could be child care, daycare centers, it could be a school, it can be things like a Dollar General, or like I said, a FedEx or Amazon, distribution facility, a manufacturing facility. It could be drive-through restaurants, sit-down restaurants, coffee shops, pretty much anything that has to do with foot traffic or more so experiential real estate that the actual client is going to the property, and that property itself is imperative to the sales cycle and generation of revenue by the underlying tenant.
And what are net lease REITs? And could you also tell us why investors should consider net lease REITs in their portfolio?
Yeah, net lease REITs are REITs that specifically focus on this type of single-tenant freestanding real estate. And these companies very specifically operate in this fashion with higher gross profit margins of close to 90%, higher EBITDA margins of close to 80%, and they focus on longer-term leases in the range of 10 to 20 years. The weighted average maturity of the leases, if you do a look-through within our portfolio of holdings, is roughly 11 and a half years. And so that gives a higher level of certainty as far as expected cash flow and expected yield. So when you combine that longer-term lease with the higher operating profits, you're able to have a protected and more consistent dividend that's not essentially correlated to market cycles. If we slip into an 18 or 24, 36-month recession, it doesn't affect net lease in the same manner that it might affect a mall or a multi-tenant office building or a multi-family asset, mainly because leases are not maturing on 1, 3, 5, or 7-year cycles. So they're set in stone longer, and the companies are required to pay on a contractual basis. So there are 23 companies in this segment, roughly $123 billion in market cap, and that's grown drastically over the last 10 to 15 years, mainly because there's been a paradigm shift where corporations are now looking to lease their real estate as opposed to own it. And if you look in the past, companies wanted to more so, buy and own their real estate, have it an asset on their balance sheet. But that requires, 30% down payment and 70% loan, and a capital stack that can be extremely difficult to manage. And so by being able to do a sale leaseback where the company sells the real estate and leases it back for a 10 and 20 year period, it's much more effective from a cost of capital perspective. And that's really been the driver behind a lot of the growth.
Okay, so when investors consider REITs, they look at REITs mainly because of their very juicy payouts, and they also act as inflation hedge. And usually, investors also enjoy significant capital growth with these REITs. So, should they consider net lease REITs also for those reasons?
Absolutely, and our net lease index and strategy is extremely different than anything on the market today. The majority of the broad-based REIT products on the market are purely market cap or equal cap weighted. We've actually created a modified market cap approach where, number one, we select only net lease REITs that focus on this business model of corporate cash flows. And then the top 5 holdings are capped at 8%, which allows now 5 companies to lead the strategy as opposed to being overweight 1. And then the remaining constituents are capped at 4%. Which then pushes the majority of the index down to mid-cap and small-cap REITs, where we believe a lot of the value and growth come from. And then on top of that, on a quarterly basis, we actually test for concentration, wherein we actually look into the REITs themselves to see where the rents and revenues are coming from. And if anybody has over 50% of their revenue from one tenant, that individual REIT itself gets capped at 3.5%, and that group of quote-unquote non-diversified REITs is capped at 12.5%. And we do that to protect the index from overconcentration. And really, again, to reiterate, the corporate cash flow within this portfolio, it's really built like a credit portfolio to withstand defaults and tenant issues. So when you're looking at investing in REITs today, many investors, like you said, are looking for real asset strategies as an inflationary hedge. These rents are growing on average, roughly 1 to 1.5% a year on a contractual basis. So you're offsetting inflation with that growth. In addition, you are owning real assets, but really you're chasing yield. If you look at broad-based strategies today, they've become a little frothy, and yields are diving into the 2 and 3% range, whereas the net lease index, can yield around 4.8, 4.9% before fees and expenses, and the ETF does a good job of tracking that.
Okay. So I'm looking at the top holdings: StoreCap, Realty Income, National Retail Properties, REIT, and WP Carry. These are the REITs that get about 8% weighting each in the portfolio. Could you tell us a little bit about some of the top holdings?
Sure. Ironically, or coincidentally, if you will, my partner was the head of credit for Store Capital, which is one of our top holdings.
Yes.
And I actually started my career as a finance and credit analyst at Store Capital. So that's how we cut our teeth on this business. And it's pretty unique that you'll see two folks that have spent their careers within these businesses leave to start a product or a strategy that circles and really highlights that business. Store Capital, Realty Income, WP Carey, REIT, all these companies, National Retail, they all start and do very similar functions. They play in different credit spectrums. Some play more so, investment grade top names, and others play in more middle market companies. But at the end of the day, they all invest in companies that are all around us, and they're things that we use every single day. One of our, obviously, favorites is Store Capital, and it's something that they've really mastered the way that they underwrite credit and approach the market. And a testament to that was in 2017, Berkshire Hathaway actually purchased 10% of the company, which is a good flag, for the sector itself, but also for the company, and a testament to what Chris Vogt and Mary Fedewa, two of the head executives at that company, have done. But Realty Income has tagged itself the monthly dividend company, and they've done a great job over time growing their dividends and consistently paying their dividends. National Retail has been around. National Retail, WP Carey, Realty Income, all into the 90s. They've all maintained very, very high occupancy levels north of 96%, and they're great at managing their portfolios.
So switching gears a little bit, let's talk about interest rates and the impact of interest rates on REITs. REITs have done very well this year, particularly earlier this year, and that's mainly because of low interest rates. And we know that interest rates have been rising over the past few weeks, and that is the reason why REIT ETFs have, in general, underperformed the broader market over the past few weeks. So tell us a little bit about the impact of rising rates on REITs in general, and what kind of impact you expect on this ETF.
Well, first and foremost, we're of the belief, and we look across the world and we see, over $17 trillion of negatively yielding rates. We see a hunt for yield that's becoming insatiable, both in the institutional and the retail markets. You're right, REITs have definitely cooled off a little bit this year, more so by the fear of rising rates. There have been some movement in the 10-year, which REITs track very closely. But we're of the belief that rates are going to stay at a depressed level for a long period of time. And even if they don't, REITs have been around for a long time. They've become extremely diverse from their cost of capital and how they capitalize their businesses, and their leverage metrics have come down. In the net lease space specifically, you have leases that are 11 and a half years on a weighted average basis, with debt underlying in the actual companies themselves of roughly 6.2 years. So we have a pretty long runway, and over that period of time, rents are growing, somewhere between 1 and 1.5% a year. So that offsets rising rates. That being said, you're not investing in one bond. You're not investing in one lease or a group of leases. So these REITs in general are dynamic companies, and you're investing in the equity of a public company whose core competency is real estate. And so when you look at it, these companies are constantly laddering in new maturities, new interest rates, new cost of capital. They're constantly recycling properties and debt and actively managing their exposure to rates. And so even though our strategy itself is passively managed and rules-based, the underlying companies have professional management teams, CFOs, chief credit officers, et cetera, that are managing their own risk and capitalization over the long term.
Excellent. Alexei, thanks for joining us today.
Thank you so much for your time.
Joining me now is Alex Petty from Hoya Capital Real Estate, and we are talking about the Hoya Capital Real Estate ETF, HOMZ. Alex created the index for Hoya Capital Housing ETF, ticker symbol HOMZ, HOMZ. Alex, welcome and thanks for joining us.
Hey, great.
So tell us a little bit about your background and why you decided to create this index.
Yes, so we created HOMZ, or HOMZ launched in March of this year. We created the index. The actual index went live back about mid last year. The index was created, the housing the housing index was really created to kind of be this new benchmark for the broader housing market. We saw that that there was a pretty significant kind of gap in that the current ETF marketplace in the housing sector was kind of segmented between the home builder ETFs, which are exclusively on the owner side, and the REIT ETFs, which are really exclusively on the renter side. And so the index was really created to kind of unify the kind of owner, the single family owner side of the industry with the rental side of the industry.
What are some of the themes that this ETF seeks to capture?
So HOMZ was really designed to kind of capture the kind of core themes of the housing shortage. So we here in the U.S. have been significantly underinvesting in housing over the last 10, 15 years. This underinvestment is what's kind of fueling this persistent rise in housing inflation. So housing inflation, this is core CPI shelter, or this is CPI shelter, has explained half of core inflation since about 2012. And so the kind of theory is that by investing in the companies that are involved in the housing industry, that are kind of feeling the kind of tailwinds of this persistent rise in rents, persistent rise in housing costs, this housing inflation, that these are the companies that are benefiting from these kind of core themes. And from the investment perspective, for the end investor, instead of just getting hit with the downside of rising housing costs, rising rents, rising home prices, that this is the investor's chance to kind of feel the kind of tailwind of these core kind of housing related themes.
So tell us how this ETF differs from other popular home building and real estate ETFs like ITB, XHB, or the REIT ETF VNQ.
Right. So HOMZ is the first ETF that really kind of unifies the single family and the rental side. So right now there's kind of this line between the home builder ETFs, which are exclusively single family, and the rental ETFs, which are exclusively REITs. And so the kind of theory behind HOMZ was that was to kind of blend the kind of traditional home builder ETF. So there's 10, 15 home builders in there. There's about 10 or 15 REITs, but then it also kind of adds these other elements that are kind of in neither the home builder ETFs nor the REIT ETFs. So the companies involved in real estate technology. So we have Zillow, we have Redfin, CoreLogic. Companies involved in real estate financing. So there's some mortgage banks in there. There's some mortgage servicers. There's some home furnishing companies. The overall concept with HOMZ was to try to create an index that kind of captures total spending on housing and housing-related services, with the kind of goal of if you can capture this kind of total, this total spending on housing, that you're kind of really going after the kind of core housing shortage theme, the theme of an overall broader rise in housing as a share of average consumer spending.
Okay, so I'm looking at the top holdings in this ETF. Lowe's and Home Depot, they are the top holdings. And then we have Meritage Homes, Sun Communities, KB Home. So tell us how these holdings are selected and weighted in the index.
Right. So the index is kind of broken down into the kind of four major categories. So one being home ownership and rental operators. So that's about 30% of the index. This includes REITs. It includes, the single family rental REITs, the apartment REITs, the senior housing REITs, student housing. So that's about 30% of the index. The second of four categories is the home building and construction category. So this is a lot of the names that you would find in an XHB or an ITB. There's about 10 single-family home builders, and then there's about 20 home building products firms also. So that's That's the kind of the kind of two biggest categories. The third category is the home improvement and furnishing. So that's about 20% of the index. So this includes companies like Lowe's, like Home Depot, Restoration Hardware, Tempur Sealy, Wayfair, to kind of capture that kind of spending on home improvement and home goods and kind of home furnishings. And then finally, the fourth out of four categories is the home financing technology and services. And so this is your mortgage lenders and servicers, your property insurers, your title insurers, mortgage insurers, the real estate brokers, the real estate tech. So companies like Zillow, like Remax, CoreLogic, Redfin. So the kind of overarching goal was to kind of, as I said, to kind of capture kind of the total picture of the entire housing industry.
Okay, very interesting. So tell us a little bit about the performance of the broader housing sector and some of the important segments within the sector.
Right. So the index itself is up about 30% this year. It's led by so there's kind of these eight kind of major categories. The top performing category is the home builder category, up about 55% this year, followed by the kind of home building products category, up about 40%. Home furnishings up 30%. All eight of the subsectors are actually higher by at least 15% this year. And so it's really kind of driven by this kind of lower rate story. So the housing industry has become much more kind of interest rate sensitive over the last 3 or 4 years. And so what you saw in 2018 was this interest rate driven slowdown that kind of lingered into early 2019. And so at one period in 2018, the 30-year mortgage rate was higher on a year-over-year basis than at any point in the last about since about 1970. And so there was a significant kind of year-over-year headwind in rising mortgage rates. And what you've seen since mortgage rates peaked in November of last year, you've seen the exact opposite. And at one period this year, mortgage rates, the 30-year fixed, was lower on a year-over-year basis than at any prior period. And so you've kind of seen this kind of reacceleration across the housing industry since mortgage rates peaked last November. And the 30-year actually came within about 10 basis points of historic lows this summer. And so it's this kind of broader interest rate-driven reacceleration in housing, which has really kind of been this tailwind for the entire industry.
Okay, so as you mentioned, the strong performance was mainly the result of low interest rates. But we have seen that interest rates have been rising over the past few weeks, and that is why the housing sector and housing ETFs, they have underperformed the broader market in the past few weeks. So how will rising rates impact housing ETFs and your ETF in particular?
Yeah, so I think that the interest rate environment was a consideration that we had kind of during the index development process. And one thing that we wanted to kind of do was to create a product that was hopefully a little less rate sensitive than the traditional home builder ETFs or the traditional REIT ETFs. And the way that we think that we did that is by adding these kind of housing related companies that are historically inversely rate sensitive. So like the banks are historically positively impacted by higher rates. And so I think that overall the entire real estate industry obviously benefits from this kind of low inflation, low interest rate environment. But I do think that in the event that you do see a significant rise in interest rates, we think that HOMZ is potentially better positioned to kind of weather that by having holdings that are not all negatively impacted by that you'll at least kind of balance that kind of headwind out with some companies that are kind of feeling the kind of positive tailwinds of higher interest rates.
So that is the shorter term scenario. But what would you say about the longer term case for investing in U.S. housing market?
Right. So yes, like the longer term case, it really kind of all ties back to the central theme of housing shortage. So, the housing shortage is not something that can be fixed in 1 or 2 years.
Right.
It's going to take this sustained period of higher housing starts, higher building permits, more investment in existing homes. Because one effect of the housing shortage is that if you're not building new homes, then the existing housing stock is getting older and older. And what we saw in the post-crisis period was this significant underinvestment in existing homes. So there's many hundreds of millions of dollars of deferred home improvement spending on kind of necessary items that kind of built up, from 2009 till 2015, and so the kind of trends that you're seeing in the home improvement sector are really the kind of deferred home improvement spending that was building up in that prior decade, and so the kind of overall theme of housing shortage, rising housing costs. This is kind of a theme that we see kind of lingering and even building kind of into the late 2020s and kind of later. And so we're really convinced that this is a very sustainable kind of long-term kind of growth theme, kind of the housing industry as a whole.
Okay, thank you very much.
Thank you.
Thanks for listening. If you want to learn more about these ETFs, please visit ETF section of Zacks.com. Make sure to be on the lookout for the next edition of ETF Spotlight. And also make sure to subscribe. If you have any comments or questions, please email podcast@Zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.